Now move on from that for the moment, because the broader market up about 0.3%. Get across now what's been driving the market today. And a big welcome back to Ben Lebrun, client advisor at Australian Stock Report, joining us live from our CBD studio. Good to have you back, Ben. Talk us through what you're watching on the market today. In particular, it looks like really it's just the miners that are capping our gains. That's very true, but there's a lot of disparate moves. It's great to be back. I wanted to say that off the top, and big hello to you, Ingrid, and your viewers. We're getting a lot of disparate moves from markets across the globe. Really, equity markets just seem to be taking all the potential headwinds coming up, i.e. the trade war, with a pinch of salt. Now, we're really outperforming today, despite the fact, obviously, we've got a strong lead in from Wall Street. It's the banks that are powering forward. Now, we're watching those banks very, very closely at the moment. They're on our watch list. But by no means are we saying they're a screaming buy right now, but the market is just moving up. It's almost defying gravity at the moment for the ASX 200 and ditto for Wall Street. But I mean, how long have we been saying that for? It just seems that every piece of bad news potentially on the horizon is, we're just viewing it with a glass half full mentality. So it's interesting for our market that we went up and challenged 6,300 points about half an hour ago, and again we rejected the idea of trading above that level. I think we've had a high, the decade-long high is 63.06. Yep. The market didn't want to do that today, so it'll be interesting to see. I think we'll get a lot of insight into the psychology of traders between now and the close, exactly how our market finishes off, given it's a Friday, given you can't trade out of positions going into a weekend, and we've got a Wall Street session to take account of as well. And of course the jitters last night were about that trade war, but again the market just seems to be taking it with a bit of a grain of salt. Obviously the US investors and traders are very excited about earnings season. It's been a pretty good start so far, seeing growth levels of above 20%, which is above what the market was expecting. Here domestically we're focusing on earnings as well, obviously going into the crucial August reporting period. Now interestingly, our research analyst Tim Montague-Jones is suggesting that clients lighten their exposure, just lighten their portfolio, lock in some profits, which gives you that wiggle room when we go into August to be able to take advantage of some of these stocks that can either shoot the lights out. We always get some outperformers, we always get some underperformers, some big opportunities there as well. So there's a lot to take stock of, but our market's doing very well, so it's very nice. Interesting though, Ben, because you talk about the trade wars, and obviously overnight we did see a slight change in sort of risk aversion, I guess you could say, in the market, given some of Trump's comments around the Fed. And I just wonder, with our market outperforming at the moment, close to that 6,300 level, do you think we will start turning the gear, I guess, on a downwards spiral, I guess, not downward spiral, but just turning it down a notch before reporting season actually kicks off, taking a bit of these leads from what we're seeing on that shift in Wall Street? Well, we certainly can't rule it out. I mean, have a look at the performance of commodities, industrial commodities like copper. I mean, that's telling you one thing. That's telling you how concerned certain sections of the market are about the trade war. Look at the flattening bond yield curve in the US as well. That's also telling you another story. But of course, what's exciting is the potential for a lot of these earnings to outperform, in particular out of the US. I think that's where it continues to outperform there. For us, look, I certainly couldn't rule out a little bit of a pullback between now and earnings season, and that's sort of the way we're calling it. That's why we're calling for our clients to lighten their exposure just at this stage, in particular lock in some profits. Some of these, high multiple names, in the IT space, in the healthcare space, the usual suspects. Some of them have done outstandingly well, and there's nothing wrong with locking in a little bit of profit before a bit of an uncertainty. We know if some of these earnings miss by a whisker, then they're down by a beard. I just made that up, but look, it is an intriguing time. We've gone through confession season. We got one or two. I'm going to say our healthcare earlier in the week, but for the most part, corporate Australia seems to be in pretty good shape. It'll be interesting to see, in particular, some of these industrials, how they perform, because they're more leveraged, obviously, to the domestic economy. But again, just to re-emphasise, we are suggesting that clients lighten their exposure ahead of this crucial reporting season. Okay, let's talk some of the stocks that have run up, and perhaps some analysts will tell you to lighten their load on these ones, but Afterpay up 14%, $15.41. I mean, who would have thought it would have smashed past that previous high of about just over $13? From here, though, I mean, do you see it going much further? There are a few risks with this business going forward. There's obviously low barriers to entry. Competitors can easily come into this space. So you just wonder, you know, would you be adding to your positions when it's sitting up at these levels?
That's very, very true what you say there, Ingrid. And in particular out of the US, obviously there's a lot of excitement about what they're going to do in the US, but that doesn't mean that there won't be competitors just, you know, lurking around the corner. But they've got the first mover advantage, of course. Now, you know, I'm reading today that some analysts, you know, after yesterday's business update, all the analysts are playing catch up today and re-rating their target price to the upside. So not surprising to see it have two good sessions in a row. And of course, the IT sector here, we talk about, I mean, how many times have we said it's just bereft of any, you know, big heavyweight names, you know, certainly in comparison to the US, where it's all about the tech space. So this could be a real Australian success story, but you're right to say the barriers to entry are next to none. And there's no doubt there'll be a host of names looking at the good work that Afterpay is doing and potentially making a move themselves. Now, of course, you know, we're also hearing about the potential for a takeover today. You know, at the multiple that they trade at, you know, wow, it'd be a little bit of a shock, and goodness knows how much they'd have to pay up. They'd have to pay in probably the 20s somewhere. But we've learned this lesson before on these IT names. You throw the PE ratio out the window and you just strap yourself in and enjoy the ride, really. I mean, you know, Appen is one, Altium is another. There's a couple of stocks that we've been following, and they've just been moving up in a straight line. So not surprising to see Afterpay move in a similar vein, and certainly throwing down the gauntlet to be the stock of the year at this early stage of the year.
Yeah, wow. Keeping an eye on it, though, and seeing just whether it can run much harder, because after yesterday, you wouldn't have maybe thought it would have made the gains it's made today, but another 14% added to that stock today. Let's talk QBE as well ahead of earnings season. A bit of an interesting one. Some news coming out of that one, but the stock's up about 0.8% today, $9.92. Now, this one divides the market, Ben.
Oh, it really does. And it's always going to when it comes to insurers. I mean, you're pricing risk, and who on God's green earth can price risk effectively and accurately? The answer to that is no one can. So you just never know what catastrophe is around the corner. Of course, everyone talking about climate change and these kind of things. You know, is that adding to the risk of these insurers? But, you know, that being said, there is a lot to like about QBE. I've called it before as being the sleeping giant of the ASX 200. I mean, it was a former pin-up stock. You could set your watch to the dividend, but of course it's been a roller coaster ride for shareholders for the last, well, at least the last 5 years. But we've had new management in charge. Generally, the skeletons come out of the closet on the first earnings report. So we've got that past us. We're going into the first half numbers now in August. And we're expecting some reasonably good things, albeit the first half might be a little bit disappointing on the operating earnings front. But we think that a little bit of short-term pain for longer-term gain. We think it's going to be a second-half story. Who knows how the market's going to react to a second-half story, especially one that's low on trust, such as QBE. So that'll be intriguing just to see how it all goes. But in terms of valuation, wow, it is very cheap compared to its global peers. I know a lot of your viewers, as soon as you start talking QBE, their eyes just roll at the back of their head. They say, no way, we've been burned by that before. But in a similar vein to Wesfarmers, it was always a buy sort of mid-30s, sell mid-40s. We could be seeing a trading range here for QBE. Buy in the $8 or $9, and then, you know, it gets into the early teens. That might be time to part company with the stock. So it could be a trading stock, but we're expecting some pretty good things for the full year at least for QBE.
Yeah, and it was upgraded to a buy from neutral at Citi, as we mentioned there, with the price target up about 1.8% to $11.20 a share. So still got a bit to run, according to them. Ben Lebrun, we'll leave it there with you. Appreciate your time, though. Thank you.
Thanks, Ingrid.